Melissa, let's go back to that top story about a 25% tax on gas exports. The protest today at Woodside's annual meeting, the Senate inquiry brought by the Greens into the tax and the impact on future gas projects. A little earlier, I spoke with Mark Humphrey-Jenner, who was Associate Professor at the University of New South Wales Business School.
Well, firstly, thanks for having me. And Woodside actually makes a good point. So let's look at some of the numbers here. The talked about tax is a 25% tax on revenue from exports. That effectively causes prices to go down 25%. So it's been talked about oft times that for many of these new projects to go off the ground, we need a gas price of at least $10 per gigajoule. Now, currently prices are above that, meaning projects can get off the ground. But as soon as we bring in this 25% tax, well, then prices go below the $10 threshold, and then the projects simply don't occur, and we get less supply, and therefore less corporate income tax. And ironically, potentially less export tax, because the exports simply aren't going ahead. So you end up with actually less tax revenue potentially occurring with these export taxes coming in, quite ironically.
OK, so then there's the petroleum resource rent tax. That's designed to be a tax that would ultimately be paid once the price of building that project has been amortised. A bit like you've got something at home or you've got a car that's used for business, you amortise the cost, then you pay your tax. It's exactly the same for those big gas companies.
Yeah, exactly. And many of these taxes on the companies are designed to be based on a measure of profits. Now, the exact costs that are allowed in or out of the measure, well, they vary a little bit based on how the royalties are calculated. But they're all basically profit measures. The talked about export tax is a revenue tax, which is very, very different. It presupposes there's a 25% profit margin after you factor in all of the other costs, which oftentimes is simply not the case on many of these projects.
So then we go to something such as when we spoke to Mike Worth from Chevron last year, who committed to the Gorgon project, which is $54 billion, the largest private infrastructure project ever developed in Australia. He basically says, well, look, because it takes so long to get approvals for these projects, because of the uncertainty of the tax situation in Australia, we're not investing any more into Australia. We can go to South America, we can go to Africa, we can go to different parts of the world to spend our capital.
Yeah, that's absolutely right. So when you're looking at these additional taxes that are brought in ex post on projects that have already been done, it brings in additional sovereign risk. And what that does from, I guess, a financial analysis perspective is it increases the opportunity cost of capital to invest in a project, meaning the project needs to generate even higher returns for it to be worth investing in. So Shell's making the point that if the risks go up, then these projects potentially aren't viable because, well, they don't know whether they'll even break even. So they'll look at allocating the capital elsewhere while they wait for there to be some certainty, or at least certainty that makes the project economic to get off the ground.
OK, then there's another aspect of this, and that is the allegation from the Greens especially that the gas, which is an Australian national resource, that is true, is effectively being given away to these companies. And you see, say, the Australia Institute claims just $450 million in PRRT collected between 2014 and 2025. The gas industry claims $1.42 billion. So, but there's other taxes on top of this as well.
Yeah, absolutely. So when we're just looking at individual taxes, it really grossly understates the total amount of tax paid. For example, there is corporate income tax. And corporate income tax, well, that can go up to 30% for large corporations. Now, many of these corporations do actually pay large corporate income taxes. So I'll give you an example. Santos, its corporate tax rate came in at about 31%. All up in one of its most recent annual reports. And that basically tells us they are paying tax. Now, just focusing on the PRRT really ignores the broader issue, in that if you extract all of the meat from the bone through PRRT, then the projects don't get off the ground and you get no corporate income tax. So if we're looking at this, we need to consider the total tax paid by these corporations, not just one in isolation.
Mark Humphrey-Jenner, Associate Professor at the University of New South Wales Business School. As always, thanks for your time.
Thanks so much for having me.